Welcome to this Chapter 21 tutorial on GST and HST. Now, GST/HST, along with PST, is differently administered in Canada. GST and HST, Goods and Services Tax and the Harmonized Sales Tax, that it is administered by the federal government, and PST, Provincial Sales Tax, is administered by each province. Now, across Canada, that varies. In Alberta, there's only GST. There's no provincial sales tax in Alberta. When we look at provinces such as Manitoba, Saskatchewan, and BC, these provinces have the GST 5% and their own provincial sales tax, and that varies from province to province. Now in BC, we have GST of 5% and PST of 7% as of 2019 for a total sales tax of 12%. Now in Quebec, they have GST and QST, Quebec sales tax. And then in the remaining provinces, we have harmonized sales tax. So Ontario, New Brunswick, Newfoundland, Nova Scotia, and Prince Edward Island have HST. HST includes the 5% GST along with the PST in each province. And because each province has a different PST rate, the HST in these provinces vary as well. Now, GST/HST is known as a value-added tax. So each time there is a transaction at every stage in the process, GST/HST is charged, all the way from the manufacturer to the wholesaler to the retail store and to the final consumer. Whereas PST is a consumption tax, and it's basically charged on the final consumer only. Let's take a look at the next slide about GST/HST and how it's charged in Canada. GST/HST is known as a value-added tax. So if we look at this supply chain here, we start off with a manufacturer. They're going to manufacture an item and sell it to the wholesaler. So they're going to charge GST to the wholesaler, and the GST that they charge and collect, they're going to send that into the government. Now, the wholesaler would have paid that GST, and they will collect GST when they sell that item to the retail store. The difference they'll remit to the government. The retail store, when they purchase the item from the wholesaler, would have had to pay GST. And when they sell the item to the customer, they're going to charge and collect GST. And once again, they'll remit the difference to the government. The customer, the final consumer, will pay the GST to the retail store. Now, if this is a province that charges GST and PST, the customer will also pay the PST because they're the final consumer of that product. Moving on to the next slide, let's talk about the method used to calculate GST/HST in Canada. It is known as the invoice credit method. Using that same supply chain, let's look at what we have here. We have a manufacturer. They're going to sell their item to the wholesaler for $10,000. They're going to collect 5% GST. We're just looking at an example where we're in a province that charges GST. And so they're going to collect $500 of GST, and they're going to send that into the government. Now, the wholesaler will have paid that $500 GST to the manufacturer. They're going to get credit for that. Now, when the wholesaler sells that item to the retail store, they're probably going to mark it up. Let's say they mark it up to $25,000, and so they're going to collect $1,250 from the retail store, and so they're going to remit the difference of $750 to the government. Now, the retail store would have paid the $1,250 to the wholesaler. The retail store is going to get credit for that. Now, when they sell that item to the customer, maybe they sell it for $50,000, so they're going to collect GST of $2,500, and so the difference they're going to remit to the government. So the total GST collected in the supply chain example is $2,500. Now, another way of thinking about it is that the GST overall is going to be 5% of the final sales price of $50,000, which is $2,500. Now, because the GST/HST is assessed at every stage of the transaction, the government's going to get their tax revenue sooner rather than waiting for the final sale to the customer. Moving on to the next slide, let's talk about how GST and HST is charged on what we call taxable supplies. Now, taxable supplies, there's sort of two categories. There are those that are fully taxable at if we're looking at a province with just GST, at the full 5%. So restaurant, meals and beverages, clothing and footwear, furniture, legal and accounting fees, transportation within Canada, GST is charged at the full 5%. These are known as fully taxable supplies. Now there's another category of taxable supplies that are charged 0% GST. These are known as zero-rated supplies. These include prescription drugs, medical devices, basic groceries, and most agriculture and fishing products. So zero-rated are also taxable supplies, but they're taxed at a zero rate of GST. So if you are a vendor and you sell taxable supplies, whether they're fully taxable at 5% or zero rated at 0%, you're going to get credit for all the GST and HST that you pay in your business. And the GST and HST that is paid in the business, those amounts will be returned to the vendor. They're known as input tax credits, or ITC. So vendors of fully taxable or zero-rated supplies, they're going to charge GST when they sell their goods to their customers, but they're also going to get credit for all the GST and HST that they pay for all the expenditures they make in their business. Those are known as input tax credits, or ITCs. So moving on to the next slide, taxable supplies can be either fully taxable or zero-rated. Vendors of taxable supplies will get the full input tax credits on their expenditures. Now there's also another category known as exempt supplies. Exempt supplies, there's no GST charge, no HST charge, and vendors of exempt supplies cannot claim ITCs. So what are some examples of exempt supplies? Basic health and dental care, financial services, sales of used residential housing, long-term residential rents, education courses, and childcare services are some examples. So providers of exempt supplies do not charge GST or HST, and they also cannot claim any input tax credits that they pay out. And so because vendors of exempt supplies are not eligible for input tax credits, usually what will happen is the GST and HST that they pay on their expenditures is a cost of doing business, and that will likely result in higher prices passed on to the customers. Moving on to the next slide, who is required to register for GST/HST? Now, if the person is providing taxable supplies in Canada, they're required to register. So taxable supplies can either be fully taxable or zero rated. Now, there is an exemption for small suppliers. So who is a small supplier? If you have less than 30,000 of taxable supplies per year, you're considered a small supplier. You don't need to register and collect GST/HST. Now, you may want to voluntarily register to charge GST and HST because that will allow you to claim your input tax credits. If you voluntarily register as a small supplier, you will have to charge GST/HST, but then you could claim all the GST and HST that you pay for your expenditures in your business. Now, how do we test this 30,000 per year? There's two tests. There's a most recent or last 4 calendar quarters test. If in the last 4 calendar quarters, the taxable supplies are over $30,000 cumulatively, then you need to register and start collecting GST/HST. There's also a single calendar quarter test, which says that if within a single calendar quarter, the amount of supplies is over 30,000, then you need to register as well. What we'll do is we'll look at some examples of these two tests. Moving on to the next slide, let's look at the last 4 calendar quarters test. If the cumulative taxable sales are over 30,000 in the last 4 calendar quarters, the business must register and start collecting GST/HST. So let's look at this example here. ABC opened their doors on July 1st, 2020, and these are their taxable supplies in the first 4 quarters. In quarter 1, they had revenues from taxable supplies at 10,000, quarter 2, 8,000, quarter 3, 20,000, and quarter 4, 11,000. So based on this last 4 calendar quarters test, we have to figure out in which quarter they exceed the 30,000. And so looking at the numbers here, it would be in quarter 3. In quarter 3, they would have exceeded the 30,000, 10,000 in quarter 1, 8,000 in quarter 2, and 20,000 in quarter 3, which is the January to March quarter. They would have exceeded the 30,000. So what did the rule say? The rule says that you will cease to become a small supplier, and then at the end of the month following the quarter in which the 30,000 limit was exceeded, you would have to start collecting GSTHST. So the end of the quarter is March 31st. At the end of the month following, which will be April 30th, they cease to be a small supplier. So on the first day after that, May 1st, they must start charging and collecting GST or HST depending on the province that they're in. And so on that very first sale, March 1st, or if it was on March 2nd, 29 days after that first sale, they must formally register. So they must start collecting GSTHST on May 1st onward, and they have to formally register within 29 days of that first sale. Moving on to the next slide, let's talk about the other test, the single calendar quarter test. They must register if in a single quarter they exceed that $30,000 threshold. So let's look at this example. Zed Limited opened their doors on January the 1st. And these are the revenues they had from taxable supplies during the first 4 quarters. Quarter 1, quarter 2, 3, and 4. And so if we look at the 4 quarters here, they exceeded 30,000 in a single quarter. That was in quarter 2. And this is a little bit different. In quarter 2, the sale that caused them to exceed that $30,000 limit, they must start collecting GST on the sale that caused them to exceed that $30,000 limit. So if a business is a small supplier and they have not registered for GSTHST, and they know that within a certain quarter, they likely will exceed that $30,000 threshold, they're going to have to keep track of all their sales. And on that sale that will cause them to exceed 30,000 within that single quarter, they're going to have to start collecting and charging GSTHST on that sale onward. That's going to be known as their deemed registration date. And also within 29 days of that sale, of that deemed registration date, they must formally register. They're going to have to start charging and collecting GSTHST from that one sale onward, but in terms of formally registering, they have 29 days from that date. Moving on to the next slide, let's talk about input tax credits. Now we're going to focus on 2 categories. The first category is input tax credits, the GSTHST paid on current expenditures. Now there's no matching required. For example, let's say that a company purchases inventory and they pay GSTHST on those inventory purchases. They can claim the input tax credits when the purchases are made, not when the inventory is sold. So there's no match required like there is for accounting. Now, if there's a current expenditure, but not all of that current expenditure is used in their commercial activities, if the current expenditure is used 90% or more in the commercial activity, then they can claim the entire input tax credit. If they fall between 10 and 90%, they use that current expenditure, let's say 50% in their commercial activity, and 50% is used for personal use, then they have to prorate the ITC. They can only claim 50% of that input tax credit. Now, if they fall at 10% or less of use in a commercial activity, then they cannot claim any of that input tax credit on this current expenditure. So that's how the rules work for current expenditures. Moving on to the next slide, let's talk about capital expenditures. So they purchase a machine, they purchase a piece of equipment, that would be a capital expenditure. Also, there's no matching required. The day that they purchase the machine or equipment and they're charged GSTHST, they can claim that input tax credit. Now, there's also rules with respect to real property and capital personal property. If the purchase is capital real property, let's say land and building, let's say office tower, their head office, or a manufacturing building, they have to also follow the same guidelines as with current expenditures. If that real property is used 90% or more in commercial activity, they can claim all the input tax credit. If it's between 10 and 90, they have to prorate it based on the commercial usage. If that real property is used 10% or less for commercial activity, they cannot claim any input tax credit. Now, if it's capital personal property, such as furniture, there's a different threshold. If the asset is used primarily more than 50% in the commercial activity, they can claim all the input tax credit. Otherwise, if it's used 50% or less in commercial activity, they can claim none of that input tax credit. Now, there's also restrictions on claiming input tax credit on other items as well. So look at your textbooks for those other restrictions. For example, remember for income tax rules, you can only claim 50% of meals and entertainment expenses. So if you're claiming your input tax credits on those meals and entertainment expenses, you can only claim 50% of the GST/HST paid on those types of expenses. That's an example of these other restrictions. Moving on to the next slide, let's talk about some relief for small businesses. As a small business, it's a lot of bookkeeping to keep track of all the input tax credits, so there's a quick method that's available. Now, this quick method is only available if the business has less than $400,000 of taxable sales. The business will still have to collect the usual GST on their taxable sales, so they're still going to charge their customers if they're in a province that has GST 5% on all those fully taxable supplies. But in terms of input tax credits, they don't have to track them. However, for capital expenditures, they will get the full input tax credit on capital expenditures. But in terms of the input tax credits on current expenditures, they don't have to go and track all those amounts. What will happen is, depending on the province they're in, they're going to remit their GST/HST based on a percentage of their GST/HST inclusive sales. Now, this percentage varies from province to province, so look for that figure in your textbook to find out what the percentages are in the province that you're in. Now, this percentage varies depending if the business is a reseller, a retail store, for example, or a service provider like a hair salon. The higher the percentage, the more the business will have to remit. Now, hair salon or service providers will generally have a higher percentage because they generally will have less expenditures. There's also a 1% credit on the first $30,000 of taxable sales. So that's going to reduce the amount that the business has to send into the government. Let's take a look at an example of the quick method on the next slide. We have this retail store in British Columbia that has annual sales before GST of $125,000. If we add the 5% GST, the GST inclusive sales are $131,250. Now, this business has a bunch of current expenditures, but they don't want to keep track of all those input tax credits, so they want to use the quick method. However, for capital expenditures, they spent $20,000, and they have to keep track of the input tax credits for capital expenditures because they can claim those separately. Now, assume in BC that the quick method rate for resellers, for example, the retail store, is 1.8%. What they'll do is they'll still charge their customers the 5% GST on all those sales, but when they come to send in the GST to the government, all they're going to do is take 1.8% of the GST inclusive sales, and that's the amount they have to remit, the $2,363. They're not going to take the 5% of the GST minus the ITCs. They just get to apply this 1.8%. It's a lot quicker. That's why it's called the quick method. However, they also get the 1% credit on the first $30,000 of sales. So if they reach $30,000 of sales, they're going to get this credit of 1%. That's going to reduce the amount they have to send in by $300. Now, in addition to that, they get to claim ITCs on capital expenditure separately. So the 5% they paid on the $20,000 of capital expenditure, we're assuming it's used 100% in the business, they get to claim that separately, which is $1,000. So the amount they're going to remit to the government is going to be $1,063. So that's an example of the quick method, a lot easier than having to track all your input tax credits. Now there's also another method called the Streamlined input tax credit method. Now this only relates to the calculation of the input tax credit. If a business chooses this method, they're still going to have to charge the GST/HST, figure out that amount, but when it comes to figuring out their input tax credits, there's a streamlined method. So let's look at an example of this streamlined input tax credit method. Still collecting GST/HST on their taxable sales. The input tax credit will be based on a multiplier for most of their purchases. Now the multiplier is the GST/HST rate in that province divided by 100 plus the GST/HST rate in that province as well. So if a business in BC, let's say, has $100,000 in expenditures, the input tax credit based on the streamlined method would be $100,000, that's their expenditures, times the GST rate, 5% in BC, divided by 100 plus that 5%. So their input tax credits would be $4,762. They would still have to figure out the total GST collected minus this $4,762, and the net amount would be what they have to remit to the government. Now there are some purchases or expenditures that do not qualify for this streamlined method. So here are some examples. If the company makes any purchases where they pay 0 GST, or they're exempt supplies, there's no GST on that, those cannot be included. Capital expenditures, again, they get to claim separately, so that would not be included in this streamlined method. If they buy anything from non-registrants, maybe from small suppliers that are not charging GST, those do not get included in this calculation. And also expenses that are not eligible for input tax credits. For example, remember we talked about 50% of meals and entertainment. Those are not allowed for income tax purposes. The 50% GST would also not be allowed as well. Moving on to the next slide, let's talk about some filing requirements. Now, how frequent are businesses required to file their GST/HST return? Well, it depends on their level of sales. If the business has taxable sales of greater than $6 million, they have to file monthly. The GST/HST return is due 1 month after the end of the filing period. So we have a company that operates on a calendar year. Their GST return for January would be due at the end of February. For businesses that have taxable sales between $1,500,001 and $6 million, they have to file quarterly. So if a business has a calendar year, the first quarter would be January to March 31st. The GST return for that quarter would be due April 30th, 1 month after the end of the quarter. Now, taxable sales less than $1,500,001, businesses in this category can file annually. So they could file the calendar return 3 months after the end of that period. So that would be due basically March 31st the following year. Now there is an extension for individuals. Individuals that are self-employed that have a June 15th T1 filing due date, they can also file their annual GST return if they fall into this category by June 15th of the following year as well. And once again, these are only filing requirements. Now, those that fall into the quarterly or annually category can choose to file more frequently. So a quarterly filer could adopt monthly filing if they choose, and an annual filer could adopt either quarterly or monthly filing. Now, they may want to do this if they have a lot of input tax credits that they know and they want to get the money back sooner. That might be a reason why they might want to adopt a greater frequency filing period. Moving on to the next slide, let's talk about payments and installments. Now, the payment of GST/HST is due when the returns are due. So once again, if you're a quarterly filer, you're a monthly filer, you have to file your return on a certain date. You also have to pay on that certain date. Now, the exception is annual filers that have a June 15th filing due date. Annual filers generally have to file their tax return within 3 months of the end of the year. That's when the payment would be due as well. But remember we said on the last slide that if you're an individual that's self-employed and you file your tax return, your T1 return on June 15th, you can also file your GST return or HST return on June 15th as well. But any payment is due by April 30th. What about installments? Now, installments are not required for monthly or quarterly filers. However, they are required for annual filers if the GST/HST that was remitted in last year was $3,000 or more. So there's this minimum $3,000 threshold. If it was less than $3,000, then annual filers do not have to make quarterly installments. How do we calculate these quarterly installments? Well, 1/4 of the tax that was owing from last year. And when are these quarterly installments due? They're due 1 month after the end of each quarter. So if you're having a calendar year, the first quarter would be January to March 31st. If you're an annual filer and you need to make quarterly installments, that first installment will be due April 30th, 1 month after the end of the first quarter. Moving on to the next slide, the last topic we're going to talk about is the GST/HST new housing rebate. Now, there is GST and HST charged on residential properties that are new. There are some exceptions, but basically the first time a new home is sold, GST/HST would apply to that sale. Now, the rebate in provinces that charge GST and PST, the rebate would be 36% of the GST paid. Now, there are some limits, and depending on the price of the house, it may be completely phased out, this rebate. In provinces that have HST, the rebates and the price thresholds vary from province to province. So we're just going to focus on provinces that administer GST and PST. The rebate is 30% of the GST paid within limits. Now, the maximum GST is on a house that costs $350,000. A house that costs $350,000 times 5%, that would be the GST paid. 36% of that would be $6,300. That's the maximum GST rebate you can get in a province that administers GST and PST. Now, it's phased out once the home price is over $350,000. The GST rebate starts phasing out, and it's completely eliminated when the house costs more than $450,000. So it's not a high threshold in terms of the price of the house that you get this rebate on. Now, in real life, what will happen is if the purchaser is eligible for the rebate, what they'll do is rather than have to file the form themselves and send it to the government, there's a form where the purchaser can assign the rebate to the home builder, the vendor, and the vendor will just deduct the rebate from the purchase price. So it just saves a lot of time for the purchaser having to fill out the form to get that GST rebate. Now, on the next slide, let's look at an example. This is how we determine the GST rebate. A times the fraction of 450,000 minus B over 100,000. So what is A? A is the lesser of 36% of the GST paid and 6,300. Remember that 6,300? We said that's the maximum rebate you can get, and that's on a home that has a price of 350,000. So that's A. B is the greater of 350 and the cost of the home. So we look at the B, it's 450,000 minus B. Once the B hits 450,000, the rebate is completely eliminated. If we have 450,000 minus 350,000, we would have 100,000 over 100,000. You would get the full rebate. For every dollar over 350,000, the rebate will be reduced and will be completely eliminated when the house price reaches 450,000. So let's look at this example. On July the 1st, Kenny acquires a home in Salmon Arm, British Columbia at a cost of $385,000. So the GST paid, 5% of the $385 is $19,250. Using that GST rebate formula above, let's figure out what the A is. A is the lesser of 36% of $19,250 and $6,300. So the lesser amount is going to be the $6,300. What is B? B is the greater of $350 and the cost of the home $385. So the greater amount is going to be $385. So we know that because the house price is over $350,000, Kenny is not going to get the full GST rebate of $6,300. It's going to be reduced. So let's work through the formula. The GST rebate then will be A, $6,300 times $450,000 minus $385,000. That's going to be $65,000 over $100,000. So Kenny is only going to get 65% of the $6,300. So once again, $450,000 minus $385,000, that gives us $65,000 divided by $100,000, 65% of $6,300. So therefore the rebate is $4,095. And once again, this formula only applies to provinces that have GST. Provinces that have HST will have different thresholds and different amounts. So that brings us to the end of this tutorial on GSTHST. Good luck with your studies.